Basically, it's the impact of the Healthcare Reform Act. As everyone knows, it just got upheld by the Supreme Court, so it's in play. So we want to get started. The first thing I wanted to tell you is the name of the bill. It's Patient Protection and Affordable Care Act. Came out March 23rd, 2010, so it's been in the media for the last couple years, and this presentation is going to just talk about some of the major provisions impacting employers and employees. It's going to talk about some tax side of things, some of the mandates, and what I wanted to do is tell you a little bit about who's impacted. Everybody, almost. I mean, you have employers, employees, Medicare, Medicaid, uninsured, obviously, healthcare providers. So with this Healthcare Act, it's almost impacting everyone. So I just want you to be aware of that. I want to talk a little bit about stuff that's already in place since the bill came out, but it's important because it's going to be continued to be in place as we go forward. And the first thing, which you may be aware of, is the small business credit that came out of this. It's called the Healthcare Credit. And essentially what this means is if you have 25 or fewer employees and an average wage of less than $50,000, you may be eligible for 35% credit of the premiums you pay. Now, you have to pay at least 50% of the employee's premium. So if you do that and you fall in these parameters, you may qualify. And the reason I say you may qualify is because it goes up, and it's a sliding scale. So what that means is if I have 10 employees and I have exactly $25,000 of average wages, I get the full 35%. But as I go up to 11, 12, 13, 14, 15, and my salary average goes 26, 27, 28, it starts to reduce in the credit. So what I've done at the end of this presentation, you'll see a slide that shows the sliding scale. Other things to be thinking about is that owners of the company or their family don't come into the calculation. So essentially, it's just the employees of the company, not the owners if they're on payroll or their family. So they come out of the calculation. So you might think, I have 15 employees, well, I may only have 10 that qualify for the credit because I don't have to include my family and myself as the owner. One other thing is that if you are approved for the credit, and let's say the credit's $1,000, you can't deduct that part of the health insurance expense. So your health insurance expense will be reduced by $1,000 because you're getting the credits. It's just something to remember. In 2014, it goes up to 50% of the premium. Through 2015, after 2015, it's gone. Okay, and also nonprofits can apply for this credit as well. It's done on the return. They get 25% through 2013, and then 35% 14 and 15. So not only can just regular businesses, nonprofits can get this as well. So like I said, you may get partial credit based on how many employees you have and how much their wages are. We have seen some of these credits, and they have been pretty good. And 35% of a premium, I'd say the average that we've seen are around anywhere from 20 to 22% based on how many employees and the average wage. Something else in 2010 was a $250 rebate was started for the Medicare beneficiaries who reach the Part D coverage gap, essentially the donut hole. So they'll get a $250 check every year until 2020. As well as wellness grants for employers with less than 100 employees. Essentially, if you spend money on screenings, disease management, fitness programs, lifestyle management, if you're doing something in your organization to pay for these types of things, a lot of times that'll help reduce your insurance premium with the insurance company because you're educating, but also you may also apply for a wellness grant with the government and receive some of your money back. In 2010, dependent coverage, 26 or under. So for tax purposes, your dependent is usually 18 or under, and if they're a college student, 24 or under. For insurance purposes, you're allowed to have a dependent 26 and under on your insurance. So what that means is if my child is 26 years old and works for a great company and has great insurance, they technically can still be on my insurance if I so choose or they so choose. There's no pre-existing conditions allowed anymore for children under 19, no lifetime dollar limits on essential benefits, and there's no rescission of benefits unless you commit fraud. So these were things that were implemented in 2010 and are still part of the Healthcare Act. The next thing that we got to talk about is grandfathered plans. You'll hear a lot about this in the mainstream of grandfathered plans. If you're grandfathered, then you don't have to apply with all the changes and reporting requirements that are coming up. So basically, if you had a plan in place March 23rd, 2010, you are considered grandfathered. So you're saying to yourself, well, I had a plan in place then, but you can't make any changes to that plan in the meantime. So what that means is even if you change your deductibles, or if you change carriers, or if you change the amount that employees have to provide for their part of the premium, you've changed the plan, you're no longer grandfathered. So rarely, it does say material changes, but material changes are really not that big of a deal. It's small changes. Anything that you do to the plan changes it, so now you fall under this Health Care Act. And some of the things that you have to comply to are non-discrimination rules. Now, some of these things are already in your plans, but these now are required. Now your new insured group health plans must meet the tax law non-discrimination requirements, which means you can't discriminate between one party over another party, so offering managers and something one insurance and offering others a different insurance. Preventative benefits. New group health plans must provide for preventative care without cost sharing, so that's going to increase a little bit of your cost of your premium. Provider selection. What that means is the participants of your insurance plan can essentially pick any primary care physician they want, whether they're in or out of the network, which is something similarly new. A lot of plans have started to adopt this, but this is now required. Plan disclosures. Group health plans must disclose to Health and Human Services and to the public all the different claim payment policies. Everything. What this means is there's going to be more information reporting that goes out to the participants and to the government. Wellness reporting. The government's going to start collecting data on the companies that are offering wellness programs, and then they're going to look to see if it actually makes a difference in their claims, and so now you're going to have to actually submit information on this, the plan itself. And then the appeals, there must be an appeal process in the plan for the participant rights. So essentially, where most plans have this, it's now a requirement. Also in 2011 was the non-prescription medicine. Essentially, we would all have, if we had a flexible spending account or an HSA or an HRA, we were able to buy the, stuff at your local Rite Aid, like Advil, Benadryl, whatever you wanted. And so what a lot of people would do is at the end of the year, if they had some money left over in their flexible spending account because it was a use it or lose it program, they'd go to the local pharmacy and just bulk up on some stuff. And now you can't do that. It has to be prescription medicine only. And the only way you can buy non-prescription medicine with your FSA or HSA is if you get a doctor's prescription note. So if the doctor says he's prescribing you Advil, then you can go and buy it with your FSA. So that's something different. HSAs, the old penalty on that was 10%, now it's 20%. And the penalty is if you use the money in your HSA to buy things that are non-medical. So let's say you just wrote yourself a $150 check, put it in the bank, and it wasn't used for medical expenses to reimburse yourself or directly, then you're going to pay a 20% penalty tax on your 1040. Something else that changed in 2011 was Medicare Part D, income-based premiums. Essentially, there's higher premiums for people who are under Medicare if you fall into this range of $85,000 as a single and $170,000 for couples. I've seen this a lot lately. I've seen clients where their Medicare premiums have gone up maybe 3-4 times from what they've had in the previous year in 2010 because they fall in these income levels. So Medicare is becoming more expensive, the Part D part of it. Also, if you're under Medicare Part D, drug manufacturers must provide 50% discount on brand name drugs if you reach that coverage gap. In 2012, so where we are today, there's what's called the new plan summary. Okay, and plan administrators must begin distributing the summary of the health plan to all its participants every year. So whether it's changed or not, there has to be a full summary that shows the enrollment and shows all the different additions to it. And if there is a change, each participant has to be notified within 60 days of these changes. So it's very important that you realize that now as an employer, that there's going to be more reporting that has to go out to your participants. Something else you might be seeing on your bill, your insurance bill in 2012 is what's called the comparative effectiveness tax. Excuse me. Employers have to pay an annual, what they call research fee for the first year of $1 per plan participant, and that's going to rise to $2 in 2013 and 2019. And you might say, well, that's not all that much, but you will see a line item on your bill for this extra fee. And you might ask what it is. Well, what it is they're just collecting money to help with the research so that they can pay for all this information that they're gathering that I'm telling you about with these plan summaries and everything like that. So you will see that on your insurance costs. Also for 2012, the IRS now requires on Form W-2 that you have to disclose the premium cost that you're paying for each employee. So whatever the employer is actually paying out of pocket will now have to be on the W-2. Originally this was scheduled to come into play in 2011, but it got postponed. A lot of people did it willingly anyway. But what it means is now each employee will see what the employer is paying for them in the dollar amount. And this will also be for the IRS to collect data on how much employers are paying. So that's something you got to think about when you're doing your W-2s in the early part of January in 2013. All right, so 2013, we've got some major things coming into play. So we've covered 10, 11, and 12, where we are right now. Now here's the things that are coming up in the future. And these things aren't going away. FSA, health savings accounts, okay, so your flexible spending accounts. These are pre-tax salary reductions, which you probably know, which means people, your employees can defer money out of their check pre-tax to pay for medical expenses. Well, that's going to go to a limit of $2,500 a year per employee in 2013. So what people would do was they say, all right, I think I'm going to spend $4 grand this year on my medical expenses, whether it's glasses, prescriptions, doctor's appointments, and different things. Well, now they would defer that. Well, now you can only do $2,500, which that means is they're just going to have more taxable income in their W-2 and less money deferred to pay for medical expenses. Also in 2013, currently, if you itemize your deductions, you can deduct medical expenses you pay in excess of 7.5%. So anything I pay over 7.5% of my adjusted gross income, I can deduct as an itemized deduction. Well, that's going to go up to 10% in 2013, so less deduction. However, if you're age 65 or over, that doesn't change until 2017. All right, here's the big ones in 2013. The Medicare payroll tax. Medicare and hospital insurance. So basically right now, if you are just a W-2 employee, you're getting 1.45% withheld from your check for Medicare. Well, in 2013, if your earned income, and earned income is wages, income from your business, it's not things like interest, dividends, passive income from passive activities. It's basically the income you earn. If it's over $200,000 for single and $250,000 for joint return, anything over those thresholds of earned income, you're going to pay 0.9%. So it's just adding to your Medicare tax of 1.45%. Now, one thing as an employer you have to be aware of is if you know that this is going to happen, then you have to withhold it from their check. So obviously, if your employee is making $300,000, you know you're going to have to do 0.9% on 50. But if you are aware that your employee is going to be, let's say, $250 on the nose, and the spouse is making $70, and you know this, you're supposed to withhold it. Not sure how employers are going to be aware of that information or even ask for that information, but it is something that's out there. Otherwise, it will be paid by the employee on their 1040. So we'll see some changes to the tax returns coming up regarding that. So another 0.9% tax. Another big one is the Medicare investment tax. And this has been talked about quite a bit. For taxpayers with the same thresholds, $200,000 single, $250,000 joint, now this isn't earned income, this is total income, there's a new 3.8% tax on the lesser of the net investment income or the amount which exceeds adjusted gross income. So first, let's look at what net investment income is. Okay, it's interest, it's dividends, it's royalties, capital gains, it's rents, it's income from passive activities, which are activities that you're not actively involved in. It's more of an investment for you. Those are the things that are considered investment income from the IRS eyes. So let me give you an example. If I am making $300,000 a year, my adjusted gross income is $300,000 a year. And I'm married. I'm $50,000 over the adjusted gross income threshold for this tax. However, I don't pay any of this 3.8% if I don't have any investment income. So let's just say I had a W-2 for $300,000. I don't pay the 3.8% over the 250. However, if I have investment income from the things that we talked about, interest and dividends, let's say I had $20,000. Out of that $320,000 of it was investment income. I'm going to pay 3.8% on $20,000, the lower of the amount over 250 or my investment income. So something to be considering, that what's coming up is that if you've got a lot of investment income, a lot of rental properties, passive activities, you really could be paying this 3.8% tax. And some strategies maybe that you want to think about is, let's say you have a rental property and you're thinking about selling it in the next couple years. Maybe you want to do that today. Maybe you want to do that before the end of 2012. Not only are you going to avoid the 3.8% tax on that if you fall within these thresholds, but we all think capital gains rates could go up next year or the following year. And so now you're going to have higher capital gains rates and this 3.8% tax to pay on that. So maybe sell it today. Another thing is for your investments. Maybe it's time to talk to your financial advisor and move some things over to municipal bonds or something like that, so it's tax-exempt interest. So tax-exempt interest doesn't get included in this calculation because it's tax-exempt. Something else to think about if you do self-rental. Self-rental is, if I have an operating company and I set up an LLC which owns my building and my land, and my operating company pays the LLC rent, and the reason we would put it in the LLC is for protection and liability, which you can always give me a buzz and talk about. The LLC is considered self-rental. So what a lot of people will pay that rent on a higher end of the fair market value range. Maybe we start to talk about lowering that down to the lower end of the fair market value range so that you can reduce that income and not have as much investment income on your 1040. Something else to consider is maybe deferring more money in your 401k. Make sure you're maxing out your 401k. If you're not doing that, that's just more taxable income that you're putting on the tax return. If you're maxing out your 401k, that's pre-tax. It reduces your taxable income. And finally, if you're an S corporation and you used to be a C corp at one point and you have old earnings and profits from the C corporation, maybe it's a good time to pay those out now. Because when you pay out, eventually you're going to pay tax on those earnings and profits when you finalize your company or sell your company. So if you're thinking of maybe selling your company over the next few years, it might be a good idea to pay that earnings and profits out now, which is like a dividend to you, which first will be taxed at capital gains rates, and you'll avoid this 3.8% by doing it in 2012. So what am I trying to tell you here? I'm trying to tell you to come talk to us, because these are things that are very important when you're looking at tax planning. Tax planning in 2012 can be pivotal. It's going to be so much going on with new legislation, with this Medicare tax, with other taxes. Give us a buzz. We'll help you out. Something else small to talk about in 2013 is tax on device makers. I bring this up because medical device manufacturers are now going to have to pay a 2.9% excise tax on each device. And what that means is the cost is going to pass through to you, which means it's going to be costing higher to buy these types of pieces of equipment. 2014 is the next year, obviously, and there's a lot going on in this year as far as mandates. Okay, and I'm sure you've heard quite a bit about that. This was the main focus of the Supreme Court upholding this this act. So there's going to be these new options in 2014 under what's called the health insurance exchanges. Okay, and every state is theoretically supposed to have a health insurance exchange. Not a majority of them don't even have them in place yet, but they will be. And they're going to offer different plans, from platinum, which would be your best plan, most expensive, then down to gold, silver, and bronze. And obviously bronze would be your less expensive, but have a higher deductible and less reimbursements to pay. So that's kind of what the health insurance exchange is. It's going to allow employees who aren't getting great insurance at their job to go out and maybe buy cheaper insurance and get a better amount and pay for it themselves versus paying through the employer plan. And there's going to be penalties coming out for people who don't get health insurance and for employers who don't provide proper health insurance. However, if you are an employer with less than 50 employees, you're never going to owe this penalty. So if you're less than 50 employees and you don't offer health insurance, you're not going to pay the penalty. Now, if you're over 50 or more employees, it's called the pay or play rule. That's considered a larger employee for health insurance purposes. You can be penalized. There's going to be 2 different non-deductible penalties that you're going to be subject to if you're not offering health insurance or if you're not offering great health insurance. So for people over 50 employees, if you do not offer health insurance at all, and at least one of those employees goes out on the exchange and buys insurance and receives premium assistance, which depends on their income levels and how much they're paying, they can get premium assistance through the government. If just one of those employees does that, then you're going to have to pay $2,000 per year per employee for each employee that's on your payroll, except the first 30 employees that are exempt. So let's say you had 51 employees. So you're over the 50, you offer no health insurance. One employee goes out on the exchange, gets insurance, and ends up qualifying for premium assistance. Then you're going to pay $2,000 times 21 employees because the first 30 are exempt. You don't see that very often in some of the literature, but it is true. Another thing, too, is the IRS is going to be policing this penalty. They're going to be collecting it. And we'll talk a little later about how they're going to be collecting information from you as the employer to make sure you're following the rules and make sure they're penalizing you if need be. The second penalty is a $3,000 penalty. And this penalty is kind of different. Basically, if you offer health insurance to employees, but it's less than minimal essential coverage, and they go out and buy health insurance on the exchange or premium credits and get premium credits, then you're going to have to pay a $3,000 penalty. So you're probably saying to yourself, why do I got to pay $3,000 if I'm offering them health insurance, at least something? Well, what they're doing there is they're trying to get you to offer them better health insurance, so they up the penalty. You're already offering them health insurance, why not increase it a little bit and avoid the penalty? And some of the things that you're hearing is a lot of employers might say, well, then I'm just going to pay the penalty. It's going to be cheaper for me. It's going to cost me $100,000 for health insurance. It's going to cost me $60,000 to just pay the penalty. Maybe that's a route you go. One problem there that you got to think of from an employer standpoint is how's that going to affect your employee retention if you're not offering health insurance. They got to go out and get it on their own. Maybe they look for a better job. Also, you're going to see companies starting to self-insure, taking the risk themselves, putting the insurance in their name, in their company. They're sponsoring the plan. They're the plan administrator. They pay the claims because it might be cheaper from an insurance premium perspective. However, you take the risk of having major claims and having to shell out the money in your account. Also, you might want to look into implementing HSAs for your employees. It's a higher deductible plan, lower premium. And also, there's one other thing of captive insurance companies. People might want to do this if you qualify. Captive insurance companies are where you go in and you share with many, many other companies. So there might be 20, 30 companies in this captive insurance, and your premiums are just adjusted by how many claims are in this whole group of employees. And then, so if there's a big claim one year, your premium's going to go up. If there's no claims, they'll start to go down. If people come out of the captive, your insurance plan will go up. If they go into if you get more in the captive, your insurance premiums will go down. So I think you're going to see more of this group type insurance going on, or you're going to see people just paying the penalty if it's feasible. The next slide is kind of just a quick diagram flow chart to kind of show you how it works. So we'll run through that quickly. Does the employer have at least 50 full-time equivalent employees? No. Penalties don't apply to the small employer. Okay? So you're less than 50, no penalty. So if the answer is yes, does the employer offer coverage? No. Did at least one employee receive the premium tax credit or cost-sharing subsidy in the exchange? Yes, then you get penalized, and so forth and so on. So if you go down to the next one where you do offer coverage, but the insurance is less than 60%, employees can choose to buy coverage on the exchange. They get the premium assistance. You're penalized. So take a look at that flow chart. That kind of tells you when you can expect to pay a penalty. Some other things in 2014, there's no annual maximums. We talked about this before with minors and plans in 2010. Now you have to remove all annual dollar limits for participants, and out-of-pocket limits have to be the same, can't be higher than HSA plans are set up to be. There's no pre-existing conditions starting 2014, so anyone can join the group health plan. There's no more waiting periods of longer than 90 days. and there's going to be additional wellness incentives up to 20, 30, and 50% of costs. So these are things that they're going to put in place. The wellness incentive side, it's kind of difficult because they haven't really detailed that out, how that's going to work yet. Again, employer reporting. This is where the IRS is going to get their information. So the employer is going to have to start reporting all their health care coverage so that the IRS can enforce the pay-or-play mandates. And then finally in 2014, any employer with more than 200 employees, automatic enrollment in the plan, there's no waiting period. Provider non-discrimination. Again, you can't discriminate against a provider, but you don't have to go with that provider. It's kind of an awkward rule. And then the insurance market reform, which we talked about. One other thing in 2014 is the small employer cafeteria plan. If you're under the 50 employees, you can offer a cafeteria plan for your employees to reimburse the premium themselves for the premiums that they're paying to the exchange. And also the final thing for 2014 is the mandate for individuals. So if an individual doesn't get their health insurance, so you're not offering it, or they're not going to the exchange and getting themselves insurance, then they're going to get penalized. And in the first year, it's $95, and then or the greater of $95, or 1% of their gross income. So that would be their penalty. Now, however, if you have to pay more than 8% of your gross income to pay for your insurance, you're exempt from this penalty. So if it's going to cost you more than 8% of your gross income, you don't pay this penalty. So that's going to be a lot of people. So something to be aware of. And then Medicare eligibility is going to be expanding nationally. Almost every single state will be offering Medicaid to more people. And you're wondering how they're going to pay for that. Well, the government is going to pay for that. For the first year, 100%, they're going to fund it. Then it's going to go down each year. The federal government is going to pay for this by giving grants to the states each year. And the next chart is basically the same thing as we talked about before, but for the individual mandate. So do any of these following apply? Yes. There's no penalty? No. Do you fall under any of these other plans? Yes. Then you don't have to pay the penalty. If no, you got to pay the penalty. And you'll see in 14 it's $95 or 1%. 15, $325, 2%. 2016 and beyond, $695, 2.5%. This next slide is the small business tax credit slide I showed you before, how the sliding scale works as your employees go up and your wages go up, how their credit is reduced. And finally, I know I'm moving through this quickly, I finally wanted to give you a website to be aware of. It's called the Kaiser Family Foundation. The Kaiser Family Foundation came about in like the early 50s, late 40s, and all they do, it's a nonprofit organization who monitors health insurance. They report on it all around the country, even around the world, and for each individual state. If you go to this website, there's not anything on there you wouldn't find about health insurance, the health care bill. It's a very good tool to get your information, to understand. If you have questions, they have a good Q&A section. So just want to give that to you as an additional resource. And so in saying that, that's the end of the presentation. We're almost to 30 minutes, but I do have time for a couple questions. We did get some questions sent in to us previous to the seminar, so I only have time for a couple. So what I'm going to do is go through those real quick. And what I want to let you know is if we don't get to your question, we will get to your question later. We'll get back to you. We have your question that you've typed in, and we will respond accordingly to you. The first question that we got was, what defines essential minimum coverage? Well, essential minimum coverage means you got to pay at least 60% of the cost of all the health insurance and premium costs. If you're not doing that, you're not considered minimum essential coverage. So earlier when I was talking about an employer offering minimum essential coverage for the $3,000 penalty, then if they're at least paying 60%, they're fine. If not, they're going to have to, they'll fall under that penalty. And one of the other questions was, when was the state of Delaware going to have their exchanges in place to learn and to understand? And basically right now they don't have anything in place for the state exchange for the state of Delaware. They have received grant money from the federal government to do some testing and do some research. They have until November of 2012 to submit a plan to Health and Human Services, and then they have until January 1st of 2013 to create a state-based exchange. It has to be in place. It's not going to be running until 2014, but it has to be created. If they don't do that, then it's going to fall back on the federal government to come in and get that exchange set up in Delaware, which would be interesting to me to see how that works out from a revenue standpoint. That's all the time we have today. It was a quick 30 minutes. We've talked about a lot of information. If you want to talk to me, give me a call. My contact information is on the last slide. Send me an email. If anybody's asked questions, I will check back with you with your answers as soon as possible. But there's a lot going on with health insurance. There's a lot of penalties. There's tax things that you need to be thinking about. And you need to be talking to your healthcare provider as well and finding out which plans are best for you. So in saying that, I'd like to thank all of you for joining us today here at Faw Casson. I hope you got something out of it. And like I said, give me a call if you have any questions. And I'll have